February edition 2023 on the debt markets in India. So I'll be speaking a bit about the Indian debt markets in January, a bit about the budget, and of course the US. One, what happened in January 2023? Well, actually not much. The interest rates or the rates on the 10-year just moved up by 2 odd basis points. We closed at 7.35 in January of 2023. A bit of a pressure on the short end of the segment where rates moved up by 15 basis points around, seen because of a tight liquidity situation. It eased gradually, but there was a sense of an elevated borrowing cost on the short end because of supply pressures also. Coming to budget, it was presented amidst a global uncertainty and a tight rope between a fiscal constraint and also a growth impulse which was much needed. Well, the finance minister actually did a fantastic balancing job managing both the constraints. So there are three good things that we took from the budget. One, the path towards fiscal prudence continues. From 6.4% fiscal deficit, we moved to 5.9%. That was a promise by the finance minister to move down to 4.5% by 2026. The markets clearly love this. Two, the quality of the budget. That's most important. So if you look at the capital expenditure and to a ratio to the fiscal deficit, it's close to 75%. That means that 75% of what the fiscal deficit is, or our shortcomings are, or shortfalls or revenue shortfalls are actually needed to fund the capex in our country. Well, that's a very good improvement over the past few years. The quality of budget wherein you are using the fiscal deficit to fund capex is the way things should be. The third is the budgets assumed a very reasonable numbers. The finance minister has talked about a 10.5% nominal growth, and the tax buoyancy was in and around that region. So those three aspects are very healthy in terms of budget. But the only apprehension that we have is twofold. One is we see interest costs to revenue receipts going up also. That's we're close to 41% of interest costs to net revenue of the government. That has been going up for the last few years. And B is there's a large dependence on small savings to fund the fiscal deficit. So that needs to be watched out. Well, the markets reacted very positively. Bond markets gained by around 10 to 15 basis points after the budgetary action. The market looks forward to the RBI action later this month. On the US, the US Fed actually raised rates by 25 basis points, but the Fed Powell chairman appeared to be very dovish in statements, and hence there was an overarching rally in both the bonds and equities considering the US. Our stance remains the fact that we think RBI is at the fag end of the rate hike cycle and may actually pause as we go ahead. This is a good setting for looking into fixed income investments in India through mutual funds. Accruals are high, 7% plus, and that creates a large margin of safety for every investor. On our portfolio allocation strategies, we believe the investors who look for a shorter end of the curve or shorter period of investments should stick to liquid, ultra short-term and low duration funds. And if they move up the risk continuum, short-term funds and dynamic funds look good. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.